What's up, everyone? My name is Casey Gibson, and we're going to take a look into the infinite banking concept. What this is, it's a concept created by a man named Nelson Nash. Any of my clients I talk to about it, I always suggest hearing it from the horse's mouth, which means go to the guy who came up with the concept himself. He wrote a book on it. It's called Becoming Your Own Banker. Highly recommend. I help my clients with the concept, strategizing how to use their bank to pay off debt, purchase cars, house, for their business, stuff like that. But go get that book. It's really cheap on Amazon, and read it for yourself. It's a really easy read. It'll help you understand it a little bit better. Highly recommend that book. Now, the infinite banking concept is not a product, so you can't just go buy the infinite banking concept off the shelf. It's a process that you use to become your own bank. Also, it's not an investment, it's a banking alternative. So it wouldn't make sense to compare using the infinite banking to investing in real estate or investing into your business. What we're comparing it to is leaving your money in a checking account, savings account, which, what's your bank paying you right now on your checking or savings? It's probably less than 1%, probably less than 0.2%, right? Now, you can still use the money in, I like to call it your family bank. You're using the infinite banking concept, you're creating your family bank, and you can use that money to do the investments like real estate or the investments into your business. So again, it's not an investment, it's an alternative. Also, when you say investment, that means that there's a certain amount of risk involved, right? Now, some investments are more risky than others, but what we're going to talk about today has no risk. It's completely risk-free. It's guaranteed to only go up, and nobody's ever lost any money from this concept with the way that we're going to talk about it today. It's definitely not an investment. And I saw this quote by Will Rogers that I really liked. The problem in America isn't so much what people don't know, it's what people think they know that just ain't so, from Will Rogers. And what that means is the problem isn't what people don't know. A lot of people that I know, a lot of people that you know, and it's not that these are bad people. A lot of times they're just looking out for our best interest, but they think that they know something that isn't true. And I've fallen into that same trap before. It's a very innocent trap to fall into. Question, how does your money flow? How does your money currently flow? Most people, whenever you get your paycheck or you get paid for a job you did, it goes straight into your bank account, and then you just pay and invest from your bank account. We're going to go over a method to get all of your money back. So right now, you get paid, it goes into your account. Once you spend it, it's gone forever. That money, you're not going to see it again. What we're going to do is we're going to add one extra step to get all of your money back. All right, what we have here are three different columns. On the far left, payment calculator. The middle is the future value. On the right, this is savings account at a bank. We're going to fill in all of these different columns here, and we're going to unravel the mystery of money, because even people who are good at numbers, some of this stuff is surprising because you just never really are taught how money actually works, how interest actually works. Let's start over here on the right. Let's say you have a savings account at a bank and you have $25,000 in that. Now, it says loan balance because any time that you put money into your checking or savings account, you are giving a loan to the bank, because the bank then takes that money, they pay you a very small interest rate, and then they go out and they lend it to other people. So you're giving loans to the bank every single day, and they're using 90% of the money that you give them to go out and multiply it. Now, let's assume that your bank is paying you an awesome interest rate, which none of them are, right? Let's assume they're paying you 4%. Let's just say, for the sake of this, they are. And the term of this loan, let's say it's 60 months, right? So basically, we put 25 grand in, the bank's paying us 4%, we're going to keep it in there for 60 months. Now, let's go over here on the left, and let's say that we borrow back $25,000, or we borrow $25,000 from the bank at 6% for 60 months, okay? Now, when you see this, first thought, you're getting paid 4% on the money that's sitting there, but then you borrowed 25 and you're paying 6%. Same amount of months, you're paying more and earning less. What's your first thought on how much money? Do you think that you're going to end up paying more than what you're going to earn? Or do you think that you're going to pay less than what you're going to earn? Most people will probably assume that you're losing money on this deal. That's actually not the case, and I'm about to show you why. The monthly payment on this loan is going to be $483.32. We're going to pay it for 60 months, and the future value, meaning how much total we're going to pay with the interest, at 6% is going to be $28,999. Okay. And now if we look over here on the right, the total amount that we earn, or the total amount that we have in the bank since we didn't interrupt this, we borrowed the 25 and this 25,000 was earning 4%, we have $30,525. We can make money by making 4% and paying 6%. This is something that whenever I first realized this, it just blew my mind. This is what the wealthy know that other people don't, because your first instinct is you're going to lose money, but you've actually made about almost $1,600 by paying 6 and earning 4. Now, the reason that this is true is because that $25,000 loan that you took that you're paying 6% on, you're paying that on a decreasing balance. So, next year you're going to be paying 6% on less. The year after that, you're going to be paying 6% on less. And then over here on the savings, you're earning the 4% on an increasing balance. You have 25,000. Next year, you're going to have a little bit more, and you're going to earn 4% on that. The year after that, you're going to have a little bit more, and you're going to earn 4% on that. Hopefully that makes sense. If you pay 6% on a decreasing balance and earn 4% on an increasing balance, you're going to make $1,600, which is pretty crazy. Now, going back to the infinite banking concept, like I said before, it's not a product. It's a process. It's a concept. In theory, you could do the strategy with different vehicles or machines, but there's one that stands out among all of them for the benefits it has, and that is dividend-paying whole life insurance policies from a mutually owned company. Now, I know a lot of you are rolling your eyes right now because somebody's told you that whole life policies are a waste of money. Somebody may have told you that you can't get any cash value for years. Some people may have told you that you could lose all your money. All of these things are not true. I do this every day, and I've seen it done multiple times. I've seen policies that 10 years down the road, 15 years down the road, simply not true. Now, in order for this to be the right machine to use it with, one, it needs to be a mutually owned company. It needs to be around for 100+ years, never missed a dividend payment. That means through any recession, that means through any negative economic downturn, through anything that's happened, they've never missed a dividend payment. They've been around for over 100+ years and always paid a dividend. That's very important, because then we can look at this company and be like, okay, historically, I think it's pretty safe to say that my dividend each year is going to be guaranteed, without actually saying it's guaranteed, because they can't do that. But if they paid it for 100, 120 years, and that even through some of the biggest depressions and recessions, then I could safely assume that I'm going to get paid. Now, when we look at this, what a mutually owned company is, that means when you have a policy with them, that you actually become part owner of the company. And there's other companies that are stock companies that offer whole life. You can't do this concept with those. And the reason is the owner is not you, it's the stockholder. That means the financial obligations is to make money for the stockholder. And then dividends, any dividends you make, if you make any, are going to be taxable. And that stock company is incentivized to take risk because they're trying to fulfill their financial obligation to the stock company. Whereas the mutual company, the owner is you, the policyholder. That means their financial obligation is to make money for you being the policyholder. The dividends are tax-free for over 100 years. So you receive that dividend completely tax-free. And then long-term safety is the primary focus of a mutual company. Now here you can see famous people who've used the infinite banking concept through their whole life policies. They may not have called it the infinite banking concept, but what they were doing is the infinite banking concept. You have Walt Disney, who used his whole life to fund the construction of Disney World. Without his whole life, there may not be a Disney World today. Ray Kroc, he used his policy to fund whenever he took over McDonald's from the McDonald's brothers. He used it to fund the payments of his key employees and to allow him to run McDonald's, to grow it. You have J.C. Penney, Doris Christopher, John F. Kennedy, all the way down. You have Franklin Roosevelt, and even the Rockefellers use whole life, and they actually have a very cool strategy using trust to not only use it as their own bank, but to preserve wealth through every generation, so that the wealth, it can only go up. Every single year, every single decade, every single generation, their wealth can only go up. So let's talk about banks for a little bit. Where do banks put their money? And The answer is one of the places they put them is whole life insurance. Now, if somebody told you that banks cannot do this, there's a legal thing that makes it to where banks can't own whole life insurance, that's completely wrong. Just look up bank-owned life insurance and look at the .gov so that you know that the source that you're looking at is credible. Regardless of what your brother or uncle told you or Dave Ramsey told you on his talk show, banks own whole life. And this is just a quick snapshot of some of the top banks and how much whole life they own. And now you can't do this through an IUL or any other type of policy, because in order for these banks to be rated in that A+, the highest rating, they need to have their money in safe, guaranteed assets. And that's what a whole life policy is. It's an asset. They use it to store their money, to grow their money, to pay their key employees, and then to pay whenever their key employees pass on, they pay their family, and then they have a lot of money to pay the business to then continue operating. So let's talk about what is money. So what's the definition? Let me ask you, what do you guys think the definition of money is? Most people would say that the definition of money is just a means of exchange. What's the purpose of it, right? It's basically a middleman of, instead of doing what we used to do before we used money, and we would just barter, right? We would trade. I got cattle, you got sheep. I traded cattle for a sheep, whatever. And then they started using gold, and then they started using money. That's all it is it's a means of exchange. There's some other questions. Do you believe in compound interest? Most people do. It's one of the most powerful concepts and the powerful laws, so much that Einstein called it the eighth wonder of the world. Compounding interest, used right, can make you very wealthy. Just like the penny doubles for every 30 days or the $1 million now question. Who uses compound interest? Let me ask you, which companies do you know that uses compound interest? Most of you are saying banks actually don't use compound interest, but they want you to do it. What do I mean by that? Whenever you put that $25,000 into your checking and savings account, they immediately move it, right? Motion. And they immediately move it. They want to take their money, and that they want to take that money that you just loaned them, and they want to use it to make more money. So they'll lend it to somebody. That person will then lend it back to them, because where does it go? Back in a bank account. And then they'll do it again, and then it goes back into a bank account, and they'll do it over and over again. That's how they make so much money off of your money. The way to really grow your money exponentially needs to be moving. But we also want to take advantage of that compounding interest. Now, banks want you to believe that the only way to take advantage of compounding interest is to leave your money there, and that's simply not the case. Just like we saw earlier, we can get paid all day paying 6% and earning 4%. Do you have an IRA or a 401k? Those have been advertised as being the safest, most effective ways for you to get set up for retirement. But one, there's no guarantee as to how much. There might be a guarantee that it doesn't go below zero, but there's no guarantee as to how much will be in there when you're ready to retire. You're penalized on using your own money before age 59 and a half. I think actually recently it might have went up, but let's just say 59 and a half is what it was for a long time. Might still be. So you can't even use the money until you're older, and all you're doing is you're giving another loan. You're giving another loan to the people who want to use that money to play on Wall Street. And they're making tons of money off of fees. They're making way more money off of yours than you. That's why they want you to do it. And that's why this concept that we're talking about in this video is not talked about among the banks. It's not advertised a lot because it takes away from the managers that manage the 401ks and the mutual funds and the banks, and it gives the power to you. Actually, if you look at people who they needed their 401k during the 2008-2009 crisis, those people were SOL. They were out of luck because they needed a lot more money to be in their 401k, but there wasn't enough there. You don't control it. Somebody else controls it. And another question I like to ask people is, what do you know about your retirement account? Most people think that they know a lot about their retirement account, but they actually don't know much at all about their retirement account. So let's talk about fractional reserve banking. A lot of people have heard this term, but whenever you really look at how it works, you'll see how these banks make so much money off of our money. So let's say you deposit $10,000 into the bank. Remember, we found the best bank in the world. That bank is paying us 4% on our money for leaving it in the account, which is absolutely crazy. This is the best bank in the world for us, right? So what happens then? So they take your money, and then they're going to loan your money. So with fractional reserve banking, they can loan about 90% of the money you put in there because they only need 10% in reserves. That's why it's called fractional reserve. They just need a fraction in reserve, and they're going to loan it to somebody to buy a house, right? Along with some other people's money. Next, After that person buys that house, where does the money go? It goes right into the bank, right? So they've loaned $9,000 of your money back, and then they got it right back. So this person has loaned them the $9,000. Now they can use the 90% of that, $8,100, to loan out. If somebody wants to buy a car, boom, that's a 6% loan. And then what happens? It just goes right back into the bank. And then they use 90% of that to loan out to somebody that wants to remodel their home. And then what happens then? Somebody else, they have a credit card, so they're swiping. They're loaning it to that person at 18%. Whenever I first saw this, and the first time I heard it, I was like, this doesn't make any sense, because your first instinct is, when you're adding this up, 7, 13, 20, 38, you can't say really that they're making 38% because you average it out, right? Wrong, because of the fractional reserve banking, because they have, off of the money that you loan to them, they have 4 notes just off of this example right here, and they're going to get a lot more until basically the money is down to a penny. They just keep loaning it out, getting it back, loaning it out, getting it back, loaning it out, getting it back. That's how banks make between 500 to 1,300% on the money that you put in there. You're giving them a loan so that they can make 500 to 13%. So you deposited $10,000, they're going to make anywhere between $50,000 to $130,000 off of that money that you loaned in there. Just like these arrows show, it goes out, but then it comes back in. It goes out, then it comes back in. It goes out, then it comes back in. And that's how banks make the money. But now let's talk about what we're going to do and how we're going to take control of the banking functions of our life. And here in a bit, we're going to show you how you can pay off debts, buy cars, the whole shebang. But instead, we're going to add a step into our normal flow of money. We're going to deposit $10,000 into the dividend paying whole life, which I like to call the family bank. Right? Because we're not using this for the death benefit like a normal life insurance policy. We're using this as a bank so that we can recapture all the money that we get. And now, if we want to buy a house, we borrow it from our own bank. If we want to buy a car, we borrow it from our own bank. If we want to remodel, if we want to pay off debt, we borrow it from our own bank. And then what do? We pay ourselves back with interest, right? 500 to 1,300% stays inside the family. You loan it out, you pay yourself back. Now, this is a key part. You have to play honest banker with yourself. Let's say you owned a grocery store. Would you just go into the grocery store, take the groceries, not pay for them, and walk out? Some people might, but if you were to do that, and I can't remember the exact math, but if you were to do that, it doesn't seem like that big of a deal. But over time, if you look at 5, 10, 15 years down the road, the grocery store where the owner paid for the groceries, which is not a huge expense, versus the one who didn't, he's in a ton of a better financial position than the one who just went in and got the groceries. So you have to play honest banker with yourself. That means if you borrow money from your family bank, you need to pay your family bank back with interest. Then that extra interest that you pay your family bank is going to continue to work for you, uninterrupted, compounding interest, one of the most powerful laws in the world, for the rest of your life. And if you set it up to do it for the rest of your entire family's life, every generation, that's how you create generational wealth. Again, banks make between 400 to 1,300% on the money that you leave in there. Let's take a case study here. So using infinite banking concept for a car purchase, we could take out a loan. That would be financing, obviously. We could pay cash. That would come from our savings or our money market accounts. Or we could do it the infinite banking way, which we use dividend paying whole life. Let's look at each one. So financing. One, you have no savings, earns no interest because you actually pay interest, and you borrow from a lender at the highest market rates using future earning potential as collateral. Now, I'm not saying that all financing is bad, because there are times where you can use it as leverage to make a lot of money. But imagine if you could use your own bank as leverage to make all that money, plus you're making the money that the financing company would have made, right? Now, let's look at cash, because some people may think, well, why don't I just pay cash? Why do I need to borrow from my own bank? Why do I need to do all that? That there's actually some green here, because you're not paying interest, and you did earn a little bit of interest while you were saving it, but most of the time it's less than 1%. You pay cash, but you're still borrowing money in a sense, right? So you're not financing through a financing company, but what did you do? You had to save money. You had to pay that every month or every year, and you had to stack it up. And then when you take it out and pay for whatever you're paying for, what do? You're not paying interest, but you're giving up the opportunity to earn interest, which means that maybe you're not so far down in the red, but you're not so far up in the top in the green either. You borrow from yourself, reducing your current collateral position. It resets compounding, because you take $100,000 out of cash that was earning, say, 4% in our amazing make-believe bank that never exists. You're not earning 4% on $100,000 anymore. You got to start over. you have to start saving up again. And it gives up the ability to earn interest, which I talked about. I misspelled interest. So what's the difference? Financing, you pay a lot of interest. Saving, you earn some, but you give up the ability to earn interest and you reset compounding. So what's the infinite banking way? We save and then we use other people's money. So like I talked about before, we can make money all day paying 6 and borrowing 4. But we're going to do better than that. We're going to pay less than we're earning with the infinite banking way. That was just to show you that even with rates higher on your paying side than you're earning, you can still make money. You're going to save. You're going to enjoy uninterrupted compounding interest, use other people's money, collateralize your purchases. You're going to borrow from the lender at negotiated rates using their money, not your money. You're going to use the insurance company's money as collateral and continue to earn uninterrupted compound interest. I love that word because most people have known their entire life that it's a very powerful law, but it's so hard to use because we thought that you had to leave the money there in order to enjoy the uninterrupted compounding interest, but that's not true. Simply not true. Let's look at an auto financing example. We're going to buy this very sexy car at $35,000. Interest rate 6%, payment $676.65. The total of payments is going to be $40,598.88. And the value after 6 months of the car is like $10,000. I've fallen into this same trap. Brand new cars are not a good idea, usually. The rate of return is really, it's less than 0% or $0. Zero is being gracious, optimistic. Now, if we finance a car through our family bank, or especially design whole life policy, these are the numbers. So $35,000, it has 5 years to grow at, let's be safe and say a 5% rate. Usually it's like 5.5 to 6, but let's say 5%. The future value that we will have if we finance it through our bank and then pay our bank back the same terms is going to be, with us, we have $44,469. And then we have that as opposed to paying and losing forever $40,598.88. Would you rather buy this $35,000 car and at the end of 5 years have $44,400 in the bank? Or would you rather buy this car and after 5 years have lost the $40,500? I think that, to me, the answer is obvious. So you've made a $4,070 net return. So you profit by borrowing from your own policy. This actually goes up. In this case, if we paid ourselves additional interest like the bank would do to us, it actually goes up. Now, here's just a quick screenshot of an illustration from a policy. First year, we put in $16,000 and we immediately have access to over 13 grand of it, because this is I like to call these premium deposits, because we're essentially depositing it into our bank. And then down here at year 5, we have $36,449 that we can use to buy that car. And we could do exactly what we just did. That case study, this is how you can do it. So again, financing through an auto financing company or a bank, we get $0 rate of return. It's actually negative. Doing it through our family bank, we get over $4,000 net return. We have 45 grand at the end of it, and we still have the car. We can sell the car for 10 grand if we want to. Now, I added this slide here because this is an actual magazine that came out. It's October 19th, 2009. Just like I was telling you earlier, during that time, a lot of people were realizing their 401ks were not as safe as people thought. It says why it's time to retire the 401k and what you can do instead. And this quote pretty much sums it up. The ugly truth, though, is that the 401k is a lousy idea, financial flop, a rotten repository for our retirement reserves. And what must seem like a cruel joke to many, the accounts prove the most dangerous for those closest to retirement. This isn't how retirement was supposed to be. And that's a direct quote. You can actually read the article online, but it's a really good read. So let me ask you a question. You've probably been asked this question before. Would you rather have $1 million today or one penny that doubled every day for 30 days? Only 30 days though. So if you did this, if you took the $1 million at the end of 30 days, if you didn't spend any of it, you'd have $1 million. But if you took the penny, you would have $5,368,709. And that is the power of compounding interest. And this is a little blurry because I took it off the internet, but look at this. This is the penny that doubles every 30 days. Look at day 20. When we're 66% of the way through this, it's only at $5,242. But look, day 21, $10,400, right? And it's exponential toward the end. It's a long-term game. This is a marathon. This isn't something that, 10 days in, you're going to look, 10 days in, we're only at $5.12. right? But look, day 30, $5,368,000. That's the power of uninterrupted compounding interest. And like I said earlier, Einstein calls it the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. A lot of you have probably been like me. I was paying it for my entire life. This is a good example of how we can pay off over $450,000 in debt. So let me ask you this. If you look and add up all of these debts, we have credit cards, we have car loans, we have condo and houses, it equals $469,000, a little bit over $469,000. Let me ask you, if we pay $25,000 a year, how long would it take to pay off that debt? I want you guys to do the math real quick. Pull out your phone, type in your calculator, 469,000 divided by 25,000, and what you should have gotten is 18 years. It's going to take you a little over 18 years. But what if we could pay it off faster using the infinite banking concept? This will blow your mind, okay? So this is showing the first premium year. There's the number. That's exactly how much it equals, $469,064. In year one, we're going to put $25,000 into our policy. And we're going to have $14,366 available. And immediately what we're going to do is we're going to pay off. This is how you use the infinite banking concept. You're going to pay off these credit cards here, the 16%, the 22%, the 16%. Now, if you look, you can see the balance, you can see the payment, the interest rate, and how many months you had left. We're going to pay off as much as we can. Now, we're not going to pay any more. What you're simply going to do is you're going to pay these off, and then you're going to take the money that you were paying to them and you're going to put it back into your family bank, okay? That's what we're doing here. And then we paid this Home Depot loan down to $7,646, okay? So this is year one, the first month of your policy. You put in 25 grand and we paid off that, okay? Let's look at year two. We put in 25 grand. We have $14,871 of that available. The total funds that we have available right now is $24,327. Now, in this account right here, the $788, that's the payment that's going to us. What we're going to do is we're going to pay off now. We're going to pay off Home Depot. We're going to pay off this Macy's, Wells Fargo immediately in month 13, so the beginning of year two. And all that money is going to go to our family bank now. We were paying it to them. Now we're paying it to us, okay? And we have this private loan down here. We end up paying it off in the 18th month, so halfway through the second year, okay? Now in the third, we're still paying ourselves, our family bank, all the money that we were paying to the previous. We give ourselves the same terms. Now right here, we put in 25 grand. We have 22 and a half available of that. $48,356 available for a loan. We're going to pay off our car, and then we're going to pay down this account right here. And then in month 27, so a couple months later, we're going to pay that off completely. Okay. Now we're in year three. Remember, I want you to remember how long that if we paid 25 grand a year, how long it was supposed to take us to do that. So money in, this is a good question. So we put a total of $75,000 in our premium deposits, and we've taken a total of 50 grand out of in loans, right? Because the reason they're loans is because the insurance, your money grows tax-free. If you withdraw your money, you're going to be taxed on any gains. So the loophole that the insurance companies use is you just take out a policy loan against your money, and then you can use it tax-free, and you can use it without interrupting your interest. Okay, so I just want to throw that out there. So we put in 75, we've taken out 50 in loans. How much is left in the policy that's earning interest? So if you said 25, then you're wrong. $75,000 because we did not interrupt our interest. Okay, that's how much is left in the policy, and that's what makes this so powerful. At the beginning of this video, we talked about we could make money paying 6 and earning 4. Imagine if that was reversed. Imagine if we were earning 6 and paying 4, which is more like what would happen. Our return is going to be a lot bigger. Year 4, we do the same thing. We're going to put $25,000, and now we've hit a point to where we have more available when we put in than what we put in. And at this point, like, why would you stop paying it, right? If I put in 25 grand and have almost 26 available, and then next year I put in 25 and have almost 27 available, why would I stop putting money in? If I told you that there is a magical machine that every time you put $1 in, you got $1.25 back, how many dollars would you put in the machine? I would just stay there all day, all night, drinking energy drinks so I could stay there longer, and I'll just keep putting dollars in because, it's spitting out $1.25. And then if I came back next week, it gave me $1.50. So yeah, total funds available, $67,946. And we're going to, now up here, we paid off the car. We ended up paying off this big loan. And now we're going to pay down the condo here. So we owe $12,369, but toward the end of this year, we're able to pay that off. All right, it's completely paid off. What do we have left? What we have left on year 5, we have the house. okay, which now that balance is $181,000 because, of course, we've been paying it. Remember, this entire time we have not paid any additional money. We've just redirected where the money goes. Instead of going to the credit card companies and the banks, it's going to our family bank. Okay, I put 25 grand in. I have 26,600 available from that 25 grand, and then total funds available 78. I'm going to pay that down as much as I can and then not change anything. I'm still going to pay the 1421 for the mortgage, and I'm going to keep paying myself this money over here. And then year 6, but wait, didn't we say that it was going to take 18 years to pay all this off? Year 6, I don't even put 25 grand in. I can just put 10 grand in at the end and pay it off. Boom. I've paid off $460,000 in debt that was going to take 18 years in 6 years. And now all that money is earning uninterrupted compounding interest, and I can, if I want to, I can lower the payment that I'm making back to my family bank because you would continue to pay back those loans, right? But like, I'm debt free. And here's the thing, you always want to pay back your family bank, but if something happened and you couldn't, you actually don't have to. And I don't care what anybody's told you, you do not have to pay the loans back. What they'll do is they'll just take it out of the death benefit whenever you pass. So the loan that you took and any interest, and you don't have to qualify for these loans. Like, basically you just let the insurance company know this is how much I want to borrow, and it's like requesting money from the bank. They deposit it almost the next day, a lot of times next day. So it's very easy. So you don't have to credit checks, you don't have to worry about your credit score, you don't have to worry about anything. You don't have to worry about paying it back. You want to, but if things happen, right? If something big happens or you fall in hard times and you need to pay less, you could do that. So how much did we put in? We put in $160,000 and we paid off $460,000. It's pretty crazy. $469,000. How is that possible? Numbers don't number, right? The math don't math. We owe our family bank money now, but every year that family bank is earning uninterrupted compounding interest. We're just going to pay our family bank, and we don't even have to, but you do. You want to, because then you can open up money to use in the future. So if you want to start a business, if your kids want to go to school, if you want to buy another car, buy another house, and you're going to earn, the difference is in the triple digits. And there's a lot more I wish I could show you. This is the power of becoming your own bank. We went over auto financing. We went over how to pay off $469,000 worth of debt. This is the power of becoming your own bank. I wish I would have known this whenever I was younger. Now I have this set up for myself, for my wife, for my daughter, 2 years old. Whenever she turns 21, I'm going to give her own bank where she, at the time that I give it to her at 21, she'll be getting $2 back for every dollar she puts in. When she's my age, she'll be getting almost $4 back for every dollar she puts in. How powerful is that? She can use that money to go to school if she wants, to buy a car, down payment on a house. She can do whatever she wants with it. A little side bonus is she's going to have a life insurance for her entire life. If she gets unhealthier, which she won't because she's going to be healthy, but she's going to be able to protect her family, her kids, her husband, and her grandkids. That's just a little added bonus, is the life insurance part. Yeah, when you learn how money works and you unravel the mystery of it, it's mind-blowing. And I've always been a numbers guy, and some of this stuff I didn't even realize until I really sat down and started running numbers myself. Hopefully this was helpful. I'll talk to you guys soon. See you guys.